Let's bring in the chief U.S. economist at Barclays Capital, also Bloomberg Best on the economy, Dean Maki. John Erlichman, Michael McKee as well here with me. And Dean, you were actually above consensus. I think you had a number of about 190,000. What do you think happened?
Clearly a weaker than expected report today. I think what this report is telling us is that the business sector is slowing down notably in terms of job creation, in terms of activity in May. So there's really no other way to look at this report than it's a negative signal on where the corporate sector is at.
Oh, Dean, I found it interesting that hours worked were unchanged and manufacturing hours rose, as did aggregate hours. It looks like companies kept the assembly lines going to the extent they could. They just didn't want to add anybody.
That's correct. And so it's interesting that the income implications of this report are actually not all that negative, given that we had a big step up in the work week in April. We maintained that in May. So second quarter hours worked are tracking 4.5% right now versus 2% in Q1. So what we're seeing is a more cautious corporate sector, but at this point they haven't slowed down the production lines, as you mentioned.
Betty, you know, it's funny. We were talking earlier about how on Jobs Day this year, generally, the market hasn't moved that much. And you could make the argument it's because since the financial crisis, for traders, it has been all about the economy. Hedge funds that are focused on the bigger picture, not whether I buy and hold the stock, where's the economy going? So they invested more time in getting those numbers right. But as we highlighted earlier, we kind of got caught up in great corporate profits for a while there, and it seemed like the economy started to take a back seat. I mean, I'm just trying to get my head around why people didn't see this coming.
Right. And I mean, Dean, I think, John, you're raising a great point because the markets had really been focused on corporate profits. You know, does that dim, Dean, because of these numbers or what?
Well, I think the slowdown that's happening that's led to this increased caution in the corporate sector is really more on the consumer spending side. And consumers have really been hit hard by food, but especially energy price increases. December to April, every month we had high CPI prints, and it looks like that's caused consumer spending to slow pretty dramatically. And that's really what we think is behind the production slowdown that showed through in, for example, the ISM reading in May.
Do you buy, Dean, the argument by the Republicans, though, that because of the uncertainty in taxes going forward, that is why companies aren't hiring?
I think, you know, I wouldn't put it on that because companies were hiring quite aggressively over the last 3 months prior to May. So I don't think things have shifted so dramatically between April and May that could really account for the slowdown in hiring in May.
Well, Dean, if companies are still running assembly lines and the earthquake effect fades and income effect is still there, now we're seeing oil prices come back down. Is this temporary, or do you think we're in a real slowdown that justifies all this talk now of QE3?
I think that the second half is going to show better numbers. And it really does come down to energy prices have stabilized. They've actually fallen a bit. Gasoline prices are down about 20 cents from their peak at this point. So that means that unless nominal income growth falls off the table, real incomes are going to improve. And we think that will bring consumer spending back as we move into the second half of the year.
Okay, Dean, we're going to leave it there. Thank you. Appreciate you joining us. Dean Maki, the Barclays Capital chief U.S. economist and also a Bloomberg Best on the economy.